Andrei Lyubimov, Moskva News Agency. The threat of new U.S. sanctions rocked Russian markets on Thursday, as investors were left wondering whether they had been getting too complacent about what had been a long-expected move. Russian stocks and government bonds fell and the country's debt insurance costs rose alongside FX volatility gauges, after U.S. lawmakers introduced legislation seeking the sanctions in retaliation for meddling in U.S. elections and in Ukraine. The proposed sanctions include Russian sovereign debt as well as some of the country's banks and energy companies. The bill was a tougher version of a proposal that failed to pass in Washington last year. The ruble touched 67 against the US dollar, its weakest since January 15, and lost almost 1% against the euro to trade at 75.57. Ruble implied volatility gauges saw their biggest jump in almost 3 months. The declines came even though Brent crude oil prices reached a 3-month high. Oil is Russia's main export, and a higher price usually supports the ruble. Russian stock indexes also fell. The dollar-denominated RTS index fell 3% and the ruble-based MOEX Russian index lost 1.3%. Banks were hardest hit. Shares at Russian top lender Sberbank fell almost 5%. VTB, Russia's second biggest bank, lost 2.92%. Both banks saw their bond spreads widen. Read more. Insane, ridiculous, Russian lawmakers react to new U.S. sanctions bill. Sberbank's chief executive, German Gref, said that according to his information, major Russian banks were not included in the new sanctions bill, but he added that one should prepare for unfavorable situations. The sanctions are driving the currency lower. Also, the ruble was among the best-performing currencies in January, and concern about the sanctions is prompting investors to take positions out. Petr Kripata, chief EMEA FX and interest strategist at ING in London, said, "We were preparing ourselves for this eventuality," said Edwin Gutierrez, head of sovereign debt at Aberdeen Standard Investments. But this is understandably causing a lot of noise in the U.S. Senators have certainly tightened the language since last year. The Kremlin said Russia's economy could cope with any new U.S. measures. "Our economy has long been under various sanctions. Our economy has learned to preserve macroeconomic stability in conditions of these sanctions," Kremlin spokesman Dmitry Peskov said on Thursday. Russia's finance minister also said Moscow had the tools to shield its economy and that the central bank and finance ministry have already created a financing buffer to help protect Russian banks. Debt strain. However, sanctioning Russian government debt and of some of its firms is considered one of Washington's most potent tools because it would effectively freeze them out of international borrowing markets. Read more. Putin's ambitious plan to overhaul Russia's economy will cost $390 billion. Government estimates the measure would, however, create fewer problems than in many other developing market countries, though. It has one of the lowest debt levels in the world and nearly $500 billion in reserves thanks to huge oil and gas export revenues. For investors, though, it would come at a difficult time. The ruble had been up almost 7% for the year until a week ago, and its bonds had been big winners 2-1 bets that the central bank might start cutting interest rates again this year. Russia 5-year credit default swaps, the cost of ensuring exposure to its debt, jumped to a 1-month high as Russian dollar bond prices fell across the curve, though it was the ruble debt that dropped the most. Russia's benchmark sovereign 10-year ruble bond had a yield of 8.50%, its highest since early January, before easing back slightly to 8.4%. Data from the country's central bank shows that although their share has been falling over the last year, foreign investors still own almost a quarter of Russia's local OFC bonds. The local currency bonds are getting hit more because that is where Russia funds itself, Gutierrez added. If foreigners weren't able to buy Russian ruble debt, then, yes, that does have an impact. The sanctions would need to be passed by the full House in Washington and receive President Donald Trump's signature, but if they do become a reality, it would mark a new low in relations between the former Cold War foes.